Thanks. Hi, everybody. This is my first time at Startup Boston. I'm really pleased to be here. And why don't we give a round of applause to the organizers for this fantastic event. So let's start with finding out who in the room is a founder. Show of hands. Okay, keep those up. How about, let's say, founder curious? Okay, so you're in the right room, just about everybody. That's great. My name's Andy Wilner. I'm a co-founder and managing director of Cadence Consulting. We help other businesses to be successful. We work with clients' teams on their high-impact problems in new product development, quality, manufacturing, business systems, even hiring and finding talent to overcome their most high-impact problems, and as well as offering novel skills development seminars to help them prevent those kinds of problems from happening again in the future. So a hallmark of what we do is leave teams stronger than we found them. I'm going to introduce our panelists today. We have three. One of them's stuck in traffic, but we'll muddle through. I'm quite sure that we'll get plenty of insights in any case. So first off, on my left here, Ali Kirko, President North America at Cambridge Consultants. And on the far left, Philip Lackman, Senior Program Manager at ClearMotion. And I'll just let them each please introduce yourselves, tell us a little bit about your background, what your companies do, and then we'll get started with the discussion. Ali?
Thank you for inviting us here. It's a real pleasure to be part of the Startup Boston Week. It's certainly an exciting environment, so we're really happy to be here. My name is Oli Kirko. I'm an engineer by training, and I love technology. Cambridge Consultants is a product development and design services company. We've been in the business for 65 years. We take on 450 projects a year. We have 1,000 engineers and scientists. Majority of our staff is PhD or graduate students. We take on very exciting projects. There is never a boring day, much like the life of a founder. We love what we do. We've spun out companies as well. We've spun out 20 companies to date. 3 of them have reached $1 billion. We help Fortune 500 companies and ambitious startup founders reach their goals. And as I said, we're really excited to partner with any one of you. Thank you.
And I want to echo Ali's point. I'm very happy to be here. So my name is Philip Lockman. I'm with ClearMotion. So we are a venture capital-backed startup that got spun out of MIT, I want to say about 11 years ago. And we are trying to bring to market the first high-bandwidth, full-active suspension system. So think of trying to elevate your ride and handling capabilities of your cars beyond what they are today, and obviously have future autonomy applications as well. I've been with the company for a little over 8.5 years. I went to business school, not here, but down the street. And I've been with ClearMotion ever since, leading a lot of our business development and strategic finance activities. So excited to be here. Thank you.
Great, thanks. So we've prepared some questions to kind of move the discussion along. We're going to save plenty of time for your questions toward the end. Let's start off. Phil, what factors should I keep in mind when thinking about starting my company? For example, my financial situation, the schedule I'll need to adopt, my support system, and so forth.
Yeah, I think it's one of the first questions, I think, as any founder when you're thinking of a company. When I first joined ClearMotion, I met the 2 founders who started this company out of their dorm room. And I think one of the things that stood out for me was really twofold. One, how incredibly naive they were in the pursuit that they were having, which I think was actually an absolute asset. I think there's a level of naivete that's helpful in not knowing what you don't know, because if you knew what you should know, most people wouldn't start companies. But with that said, the incredible passion and grit that they had starting the company in 2012, when active suspension wasn't even a thing. It wasn't something the market was demanding, but the foresight that they had in trying to realize that the industry was eventually going to be moving this way and being able to take advantage of that, knowing the long industrialization process that automotive industry requires, was something that's, to me, inherent to them, but also necessary for any startup. I think any entrepreneur who I've ever spoken to who have been successful have an insatiable belief in their vision that even when they get 99 no's, they're still going to wake up the next morning and go after it. Like that's like table stakes. You have to have that. And that's not a guarantee that you're going to be successful, but that's like covered, get in the club. The next component I think that is necessary, depending on what stage of life you're in, right, is looking obviously at your finances, what risk you can take. I will say certainly also doing some angel investing on the side. One of the prerequisites that a lot of angel investors, I think investors in general, ask is, if you're looking for my check, right, what time are you giving to the company that you're asking me to write a check in? Because my money's going to be working full time. My question is, are you? And there's a lot of intangibles associated with the ability to be working full time, what that means for your life balance, whether you have a family, children, what financial runway you have, because most startups, don't come with an investor check on day one. And so these are all factors I think you need to consider whether deciding whether you can afford to and have the sweat equity necessary to get a chance to really take a company off the ground. Ali, you have any thoughts?
I guess the most common founder is out of the labs of a school. And that's, I guess, you're at the peak of the naivety. Lots of hopes and dreams.
Yeah, that's true.
But it is that passion and that grit and the courage and audacity of the pursuit of pursuing that problem, that pursuing the solution to a problem that you have identified. And every founder that I speak to has a tremendous amount of grit and passion about what they're trying to do. And it is how they leverage the ecosystem and what's available to them is what differentiates a successful founders from others.
Ali, let me ask you to kind of follow up on that notion of solving the problem that they found. How can a founder confirm that they've really found a pain point, that there really is a market need for their idea?
Yeah, I mean, there is a lot of literature out there. One of my favorite books is The Disciplined Entrepreneurship by Bill Olet, and there are 24 steps that you have to follow. One of those main steps is to identify your first customer and really be intimate and knowledgeable about that customer. What is their need? Really know the demographics, the pain point. What is that they want? And understand the willingness to pay. And also it is problems first, solutions next, is how I would think about it. And it's constant testing the market and iterating on that idea, on that initial idea.
Okay, let's throw it back to Philip. How do you go about quantifying the scale of your potential market?
Yeah, actually, can I add on?
Oh,
actually,
please. Sorry,
so I'm going to tell you
there was an awkward pause.
No, it's okay. I didn't know if you want me to continue on after her. I think Ali made a very good point in terms of quantifying the pain of your customer. I'll give you an example. The company that I've been with, right, we've all told raised a little over $300 million in over 11 years, which is an obscene amount of money. And we've spent most of it, I would say. I would say there was a phase, and this gets back a little bit to founders and kind of knowing your strengths and what you don't know. There was a time in 2016 through, I would say, 2018 that we thought we had the product. We thought we had it licked. We thought we were going to be taken off, the next hot thing. And we literally went to every single OEM who had a premium car in the marketplace and literally came like a rotating door. One of them's got to say yes. We only need one. It's like playing in the NFL. You need one team to believe in you, and if you make it, then they all will come follow. And we just kept banging that door at the expense of listening to what the pain point was that the customer was looking for their active suspension system to solve, and them repeatedly telling us in one form or another, in one language or another, here are the gaps that you still have. And we just said, you're wrong. We know better. We're going to go to your competition and think that they're going to say yes. Right? And we spent tens of millions of dollars of just headcount, keeping the lights on, trying to find that one customer before taking a step back and realizing, okay, we've heard the feedback from the customer the same year after year after year. And I was saying this being on the commercial side, right? Like when you're the representative advocating on behalf of the customer of our product isn't ready yet. So we need to shut the doors, stop trying to sell, and get the product to where it needs to be. Because until you can only take the product so far, you can only try to pull the customer in so far before eventually the product has to be able to speak for itself. And if your product isn't ready, doesn't matter how much selling that you're doing. And so to Ali's point about identifying that pain point and really quantifying it, that's measurable, right, will allow you to really focus to understand objectively, here's where my product is, here's where the customer says he or she needs it to be, and therefore, what is the willingness to pay in order to be able to meet those requirements? So I can't emphasize that point enough. Sorry, I just wanted to add some tangibility.
100%. How should people go about leveraging their past professional and academic experiences? Do you need to have technical training to build a startup?
You want to go?
Yeah, I think I don't believe you do have to have a technical training as long as you have the right team. So you'd need people that have that technical training and product knowledge. You need people that have that business knowledge. You need people that have that finance knowledge. And in the previous panel, it's not about having it all in one person. It has about how you as a team complement each other and bring together what needs to or what's needed on the product. And the experience, there is a lot of how do you leverage experience? Again, it does take a village, and it is experience that your team will have. It is partnering with external parties. It is pulling the knowledge from various aspects. It's not. It doesn't have to be in one place. So past experiences, past networks are useful, but definitely make usage of the laterals as well.
Yeah, I think especially as a founder, one of the biggest assets you can have on behalf of the company you're starting is to have enough self-awareness to know where your strengths and, more importantly, where your weaknesses are. Right? Nobody has it all. Right? And I'll say, for example, again, use with ClearMotion, one of our co-founders, incredible fundraiser, could sell ice to Eskimos, right? And really could sell the passion with which he had that helped him and his partner raise the initial Series A and B for our company, right? The challenge is that they didn't understand the difference between raising money and executing business is two completely different things, right? And being able to sell a vision and then cash a check, right, is one process, but being able to sell a product and generate revenue is a completely different world, right? And so being able to, once you're able to understand where your weaknesses are, then to leverage your network of who's good where I'm not, and have enough humility to understand that, because the sooner you do, right, the faster your company will take off. And being able to put the right people on the right seats on the bus, right? You eventually, as the company starts to grow, you're doing less of the kind of tactical firefighting, and it's more of the strategic and resource allocation activities that come along with it. And the sooner you're able to identify what that landscape is and where you fit best, which may not be, even though I'm the founder, doesn't mean I need to be the CEO, right? I think the better off your company is going to be in terms of its trajectory.
Do you have any tricks for how to go about that process of identifying one's strengths and weaknesses? I mean, introspection does not come naturally to many people. So what are some lessons learned that you've each seen where, how do people figure that out?
Yeah, I think one of the things, if you have the time, there's obviously many people probably have heard of like Myers-Briggs or those kind of, self-evaluation tools that they have. I think one thing that was actually very helpful for me once, previous company I was working for, they did 360-degree evaluations, right? So they basically had a survey that they asked you to send out not only to your work colleagues, but friends or that you had people you played sports with or whatnot, to kind of get a holistic view, because the way you present yourself in different scenarios, right, gives a different perception of you in a professional setting versus a family setting versus a social setting. And getting an understanding very candidly of, tell me where you think I excel and where I don't in different situations as you kind of modulate your personality. If you're talking to your parents versus you're talking to your wife, right, or your friends, I think can give you hopefully a perspective of understanding, right, how you are perceived versus how you think you're presenting yourself. And those two things can be very different. So I think that was one of the helpful tools of understanding kind of where I went in my career versus where I didn't, right? To try to maximize the benefits that I could offer to my company that I work for. I don't know if you have that.
Very, very similar. I mean, relentless pursuit of feedback. Just constantly seek feedback on things that you're doing. 360 is super helpful. Don't have much to add.
Well, let me jump in here and introduce our third panelist, Allison Byers, founder and CEO of Scroobius, who got stuck in traffic, but
I'm so sorry.
has joined
everybody.
us, which
That
is
was
great.
horrible.
And I'll put you right on the spot. We were talking about how a founder could assess their own strengths and weaknesses to kind of understand how they need to build out a team in the future. What are the lessons learned and tricks that you can recommend?
Yeah, so it's a great topic. And again, I'm so sorry for being late. That was super unprofessional and you all got here on time. So I'm sorry. So when you're assessing your strengths and weaknesses, there's a few different angles that I usually counsel founders to think about. And if we're talking about, an early stage startup, there's both building your team and there's also building your advisory board, which is part of your team. But you want to think both about your knowledge areas, so your expertise in your industry. And you also want to think about your skill set. So what do you have most experience in? Do you come from sales? Do you come from marketing? Are you a generalist? So it's both your industry knowledge and also what are your skills that you excel at? And then you want to complement yourself, right? And especially on an early stage team, one of the big risks or one of the big red flags is if you all have very similar industry experience or you all have very similar skill sets, then it's a little bit of a risk for how you're going to execute in the company. And so I do encourage everybody to think, and you can even write down a list. What are your skills? What is your knowledge? How do you complement that with specific other sets of skills and knowledge so that you have a comprehensive team?
Yeah, that's a really good point. If you're finding that your kind of core team is always immediately in agreement, you're almost certainly missing something. You want a diversity of thought in your core leadership. Well, let's keep going down that road. How about finding the right talent for the growing business? So you've thought about your own strengths and weaknesses, and now you're scaling a little bit, or at least growing at the beginning stages. Where do you find the talent? How do you assess the talent?
Do you want me to
Go ahead.
Okay.
Go ahead, please.
Well, I think it depends a little bit on what we mean by talent. So maybe I'll start with a little bit of a higher level, right? There are your employees that you can hire, which obviously requires funds to be able to do that and bring people onto payroll. Or, if we're talking 0 to 1, like if you're at 0, you can look for talent in other ways. It could be that you're looking for co-founders and all of you are working for equity. It could be that you're utilizing students, right? We have an amazing student population in Boston. You can work with interns, you can work with classes. There's whole classes that assign students to teams to work on projects for startups. It could be contractors where you don't have to worry about your payroll, which is a large expense for a company. You could just do hourly or project-based contractors. So I guess when you're thinking about your team, especially at 0 or at 1, there's a lot more that you can do without having to hire full-time, especially today. There's even whole platforms out there that help with this. And I'd encourage everyone to think about what do you really need to get done and what type of team member is that?
One of the things that we look for in talent, and we do hire exceptional talent at Cambridge Consultants because we do have to take deep tech breakthrough projects and deliver the results for our clients. We look for alignment to mission. We look for something that people are passionate about what we do. People are passionate to bring technology to market and our values. So very much alignment to values, attributes, and then the third is skill. So for me, when we make hiring decisions, that's what we look for first. And in my view, skill can be learned. The other ones are hard to. So unless you have an alignment and attributes, then you don't have a fit. So.
Yeah, there's an iconic management book called First, Break All the Rules that talks about this concept of talent separate from skill, where talent are the inherent personality traits and skills are those learnable task type activities. And I concur 100%. You want to bring in the talent. You can teach the skills, people can learn skills, but if they don't have the drive, they don't have the attention to detail, they don't have the big picture thinking, whatever traits you really need to succeed or to fill the gaps on your team, there's no amount of skill that's going to make up for that.
One other point I just
Sure.
want to add, because I know we took a poll of the audience, a lot of founders here. I think one of the things to consider, especially when you're starting your company, right? The scrutiny that I would place on your first and second employee, right, would be higher than your 100th or 110th employee, because the intimacy with which you will be working with that person, you're going to be married to them more than your spouse. I mean, in terms of the time you're going to spend with that person. And if you make a mishire there, right, given the limited resources you probably have at that stage in company, that's a lot to give up, especially if that relationship is not working, right? So, I encourage you, if you're looking for a partner, again, let's say you've identified where your skill sets are strong and where they're weak, and you think there's somebody either through a referral, which is wonderful, especially when somebody who you trust vouches for somebody else, that cuts a lot of the risk in terms of possibly bringing that person on board. I mean, a lot of companies, ours included, give referral bonuses because, hey, we hired you, you like this person, right? There's less vetting we need to do if there's already that network and relationship effect there. But being able to kind of ease in, I would just start slow with somebody as you bring them on board, right? And don't just kind of say, hey, I got 1,000 things on my plate, you take 500 of them, right? And then all of a sudden it could be too late if you realize that relationship and that chemistry isn't there. So just something to think about.
So I want to circle back to something we touched on before, the notion of and Philip, you articulated really well, of genuinely really listening to what your customers are telling you. I want to kind of go from there to how do I quantify the scale of my potential market? So I've talked to a few customers. I think I have an understanding of what's wanted. I think I might have a solution for that problem. How do I know how big the market is? What are the approaches that you all have taken to kind of understand the scale of what's ahead of you? You want to go first?
Sure. So, I teach bottom-up market sizing at a lot of the universities here. So I highly encourage everyone to do a bottom-up market size. I'm not going to give the lesson right now, but just the overview. There are 2 ways to size your market. It is super important, even outside of fundraising, for you to understand the opportunity of your business. Not every business is this enormous, unicorn venture scale market. And that's okay. You can have a super successful business that you don't go get venture for. Venture is not the definition of success. And maybe it is for you, but you should know yourself because it'll inform your strategy for how you grow your business. So a top-down market size is where you say, there's X billion dollars of spend in my industry, and if we get 1% of it, it's this many dollars. That is not your revenue opportunity. It can be good for context, but there's a whole lot of spend in there that has nothing to do with what you're selling. So don't fool yourself. Get your revenue opportunity. That is a bottom-up market size. This is our friends TAM, SAM, and SOM for anyone that is familiar with those terms. I'm only going to talk about TAM for a second, and then I'll move on and we'll get other takes here. But it's basically saying if everyone who could buy what you're selling, so your customers, people who would purchase what you are selling, did buy what you're selling at the price you're selling it, so your sales price, it's this many dollars. That is your total revenue opportunity, and you should know that number. It's not saying you're going to have 100% market share, but think about it. If your definition of your customer changes, so you have a different number there, or if you change the price you're selling at, it changes your market size. That's why it's bottom up. It changes your revenue opportunity. So I encourage every founder to do that. I'm not like a sales plug, but if you visit my company, Scroobius, we have a market size workshop replay that you can watch. We put out a lot of material to help you do this. There's a spreadsheet you can make. You don't have to use software or buy something. Everyone can do this, I promise.
I personally use the top down very often. I do it for indicative purposes, that it is always a good idea to have a good instinct if you're on the right direction. It's a funnel approach, right? So you start with a total, okay, there is this many billions, so there is this many hundreds of millions of users in this space. That gives me an indication that there is at least enough quantity. And then there is a segmentation. And again, there is a lot of care and thought about what is the right segment for you. So it's that funnel approach. But if you want something that is quick, indicative, and just to give you an idea if you're on the right direction, then that's, I would do the top-down approach. Now, if you're trying to design the specs, the features, and really design your product to fit that market, then I would suggest the bottoms up and really being intimate to the very individual, to the very person that is buying your product, really knowing that market, that willingness to pay, the pain point, again, coming back to that very, very well. So that requires market testing, that requires bottoms-up analysis, that requires intimate knowledge of your customer.
Great. Philip, I'm going to shift to another question. When should I pursue external investment? And what are the kind of initial steps? What's the process about going about that?
Yeah, so I like this question a lot because, there's one of the misconceptions I find. People get a lot of press startup when they get $1 billion valuation. We're a unicorn. We've made it, right? And the biggest misconception with that is if you become $1 billion valuation, there's always an expression, especially in the venture world, is, the venture capitalist says to the entrepreneur, you set the price, I set the terms, right? Meaning that the higher the price you want for your company, the more downside protection I as an investor am going to include, right? Because the higher the bar you are now assuming that if I give you $100 million, that you're going to spend that money, and after that spend, the company will be worth the valuation that we've agreed that the company is worth. All right, and that's always kind of the misnomer. Is raising the money is, again, I'm going to put this in quotation marks, the easy part, and I say that in quotation because raising money is not easy. But the actual execution of moving the company from point A to point B, which is what you promised your investors you would do with their money, that becomes the real hard part. And being objectionable about, hey, I promised X, Y, and Z when I said that, when I asked for this for $100 million, right? And I come back to you and say, did I actually execute on X, Y, and Z or not? Right? Oftentimes entrepreneurs are like, well, this happened and this happened. This was out of my control. Yes, those things are happening, but being able to be very candid with a potential investor and saying, I promised you this, and here's the report card against what I promised you. Because the biggest credibility in being able to raise follow-on capital is doing what you say and saying what you do. It's as simple as that, because it shows a level of credibility from an investor perspective that A, this person is honest. B, I know if I'm writing a check to this company, there's a likelihood there's 100 things that I don't know he doesn't know or she doesn't know. There's 100 things that I know she doesn't know that I know he doesn't know. And all these kind of dynamics that enable a level of candidness that I want when you're raising money to be just open with. So that's kind of point number one. The other point I would stress is the more you can bootstrap in getting your product to some sort of an MVP, or the more you are able to do without taking outside capital, right? The more ability you have in reducing the perception of risk to potential investors. Because at the end of the day, the dialogue you're really having with investors, the investor's saying, okay, he wants my money. What type of return can I get for this particular opportunity? But then the question is, based on that return, how much risk am I taking as a result, right? And do those things kind of square up for me? I can take a very risky opportunity that has a 1% chance of being successful, but if it's going to give me 100x on my money, okay, then that may be fair, right? So understanding that dynamic is very important. I see a lot of entrepreneurs that say, I got an idea, I want to go raise money. It's a very tough sell when what you have is your credibility, right? And an idea of which you haven't done little to nothing in terms of trying to execute. And so I always try to encourage entrepreneurs, unless you can find somebody who sees the world the way you do and has the same vision you do and says, I know the pain point you're talking about, I've lived it. You don't have to sell me on the pain point, and I have financial means with which to write you a check. Unless you can find those kind of people, which depending on what you're trying to go after, sometimes they're more plentiful than others, right? I highly encourage try to get the product or service or whatever you're trying to bring into the marketplace as mature as possible, because it's going to pay huge dividends when you're looking to raise money. Because now you can say, hey, let's say you have a product and say you have one paying customer. That's a huge value proposition to an investor versus them saying, hey, I got a great idea and I know people are going to pay for it. I'll actually have actual market evidence that there's somebody who does. And that's a huge inflection point in terms of the valuation of a company, right? And that in the eyes of an investor, the day before somebody says the day before you get your first customer and the day after.
Adding to that, I mean, absolutely true, and I couldn't emphasize enough exactly what you just said. Is get to the promises, get to the results that you promise. That builds the credibility with the investors. You don't need revenue. Early phases, you won't have revenue, but meeting the valuation promises, it's critical with the investor. That establishes your credibility, and who is in your investment portfolio also matters. So really choose carefully those early investors. That must be strategic partners that are going to be advocating for you. They're going to be sponsoring you, because the investors attract the other investors as well. And who is on your advisory board as well also matters. So really be thoughtful about that. And the other specter that I wanted to bring in maybe later in the phases is think about various sources of funding. So there is funding, there is seed funding, the various series, but then the later on phases, you could also get loan money so you don't dilute your value, especially during the pilot phases. So you don't have a paying customer, but you got commitment for piloting. During that phase, you could probably lend money rather than loan money rather than try to further dilute your valuation. So there are various techniques how you can manage your cash flow, which is key during your survival.
Allison, on the same theme of cash, what are the macroeconomic factors that founders ought to be considering? Things like interest rates, and how do those things affect your approach?
I can't answer that. Can I add?
Oh, sure, please jump right in.
Because I just want to, I mean, for those of you that don't know me, I work with primarily underrepresented entrepreneurs at the very early stages. And so the first thing, if we just kind of take a step back from talking about venture funding, the first thing is to decide what type of funding is right for you. It's not always equity funding, and there are very different types of equity funding. You should also know what will be the most efficient use of your time, know the statistics, right? So I cite a lot of data. In Massachusetts, 0.9% of venture funding goes to women. 99% of venture funding in Massachusetts goes to men. If you are a woman raising, you should know that. 0.56% goes to Black founders. 99.5% of venture funding does not go to Black entrepreneurs. You should know that. I don't say it to be discouraging, but know what is the right use of your time. Venture is not always the answer, both because of your business model, it might not be the answer, but also just know where you're likely to get funding. And it's not meant to discourage, right? It doesn't mean it won't happen. And you also don't have to raise from Massachusetts. There are a lot of ways to reach investors that are not here. I've raised over 10 million for my companies, primarily not from Massachusetts. And so I just want everyone to know the truth about what's out there so you can be realistic and respect your own time. And then when you're deciding if you need external funding, the first thing you should do is picture, what do you want for your company? It's your company. You get to decide. You're at stage 0. You get to decide. If you take equity investment, you have to be working to an exit. That's the only way your investors get money back, that they get a return. Maybe you don't want that when you picture your company, right? In 5 to 10 years, do you want to still just be running your company? Do you want to build it to be a profitable, self-sustaining company that you run indefinitely? Maybe don't take equity investment. Look at other types of funding. So the first most important step is, what do you want out of your company? Because if you don't want to be acquired within 10 years, if you don't want to have an IPO within 10 years, really think about where you're seeking money, because you will automatically have that conflict of interest, like you were talking about before. You have to meet growth milestones so you can exit as soon as you take equity investment. So I just wanted to make kind of those points about when is the right time for you. First decide on those things before you go out so you're aligned. So sorry, you wanted to talk about macroeconomics?
Just briefly.
So in terms of like, when would you take on debt financing or loans? Or
Well, it's kind of a broad question that, we came up with in the prep. So you can take it whatever direction you think is most
You
beneficial.
want to chime in first on?
if you want to, feel free.
Yeah, so I think one of the things, hopefully some of you probably realize, obviously it's not news that interest rates have gone up, right? Obviously borrowing money is a lot more expensive now than it was several years ago. That has obviously direct effects on how you see stocks in the public markets, but conversely, it's also had direct impacts on private markets as well. I'll give you intimate experience here, like at the company I work for, when we raised our Series D, and this was, 2018, if you had any story tied to autonomy, everybody thought autonomous vehicles were going to be here tomorrow, right? Elon Musk, car's going to drive from LA to New York next week, right? I mean, all these kind of grandiose claims. If you had any story tied to autonomy, venture capital was throwing money at you, right? And we had a very compelling story around autonomy and active suspension and mitigation to motion sickness. I mean, we were riding that wave. Okay. Fast forward 3 years, we almost closed the doors. Right. Why was that? Because again, as I mentioned before, and so did my panelists here, when you are taking on money, you are making promises of where you expect you will be with that money. Right. The investors aren't going to hear, well, from the entrepreneur, well, the economy changed, I'm sorry. Right. It was out of my control. Yeah, a lot of things are out of your control. Right. But you could have been better stewards of managing my money in terms of your spend. Right. Is always kind of the counter argument there. So my point being is we raised money at $720 million post-money valuation. Right. And we were a pre-revenue company. Right. I mean, a lot of companies are going. This was like during the SPAC IPO days. And you just saw anybody with half an idea that was looking good and had revenue 10 years down the road was getting credit like they were getting revenue today. And I say all that to say is that we now raised additional capital at a far lower valuation than we did 3 or 4 years ago. But the maturity of our product is much further down. We actually have a purchase order. We're going to production. We've done a ribbon ceremony where we got our manufacturing plant started. So we've done a lot more. The company is a lot more de-risked than it was 3 or 4 years ago, but the valuation is like a quarter of what it was 4 years ago. Part of that is because, just like in the public markets, as interest rates go up, right, and there's a higher hurdle with which to be able to make money if you're going to borrow it in order to invest. There's therefore a higher scrutiny as to what investors are expecting from a company if you're asking them to write a check, right? So you have to think about what are the goalposts that investors have, and this gets back to why it's easier to raise money the more you've been able to de-risk the business, right? Because if investors before were looking for, I don't care if you're pre-revenue, if you got revenue coming in the next 5 years, I'm happy to write a check, right? Because again, it's easy for me to borrow money. Now it's I got to borrow at 6-7%, right? Now I'm saying, are you profitable today? Are you going to be profitable tomorrow? Otherwise, I'm not interested in what your story is 5 or 6 years down the road. Right? And so the psychology of how investors look at opportunities is something as an entrepreneur you need to be cognizant of, right? When you're looking to raise money, so you understand what the goalposts are with regard to their risk threshold. And a lot of that has to do with what the macro forces are that are happening around the world. So just something to think about. Anything else you guys want to add?
I think if can you answer in 30 seconds? 'Cause I want to leave time for some questions from the audience. Okay, so with that, why don't we throw it open to questions?
Okay. Hey there. So you talked at the beginning, to be successful, you have to have like the grit to keep going, to hear 100 no's. But then you talked about you heard 100 no's because people said the product wasn't ready, but you weren't listening to them. So how do you balance like when to listen to the no's? Because like it sounds like you guys should have listened earlier in your situation, but you also have to know you have to keep going.
Yeah, no, I think it's a great question, right? So there's the hearing 100 no's when it comes to raising money and hearing 100 no's when it comes to your product not being what they're asking for. It's a no, but a no potentially for different reasons, right? You will hear on the investor side, and this is where I made the point before, is raising money and executing business is 2 different things. It's not the same. And you really have to kind of bifurcate your mind that when you hear no in one category, it's for different reasons than when you hear no from another category, right? And so I think that's an important distinction to make. So when you're hearing no's on the investor side, right? Oftentimes with investors, they won't say no, they'll just kind of ghost you, right? If you don't hear back from an investor, that's their polite, passive-aggressive way of saying, I'm not interested. I don't want to say no to your face. I don't want to hurt your feelings. So let me just pretend like I got 1,000 emails and I just don't have time for you. Now, I will say on the investor side, right, investors get bombarded, right? And my colleague here made a good point. There's a lot of different ways with which to get money. Venture isn't like the end all be all. And I think it's a very important point of distinction, right, of what type of investment do you want to take. I can say on the venture side, because it's where I have the most experience, right, they get bombarded with hundreds of opportunities. There is far more ideas than there is capital with which to be able to meet the demand, right? So don't get discouraged with on the investor side. If you either hear no or you hear silence, just move on, right? You want to have a list of here are the target investors who I'm going after and have a running tracking sheet of making sure that you are staying in contact with those that are actually giving you some traction. Measure them by what they do, not what they say, right? If they are asking for information about your company, right, that's a diligence sign. That's great, right? Make sure you have your virtual data room ready to go if you're looking to raise money, right? You should already kind of know what questions investors are going to be asking and have the material ready because it helps to facilitate them moving fast if you're looking for capital quickly. Hearing no from customers is a different ballgame of hearing that your value proposition doesn't meet the cost you're asking me to pay. So one of two things has to change. Either you got to lower your cost because your product isn't as good as you think it is, or your value proposition has to be higher in order for me to pay what you're asking me to pay. And understanding those two levers, because when those two things work for your customer, you're going to get an order. Now, every customer may say your value proposition is here, depends, right? But again, that's to the point I made before about listening to your customer and what is the pain point and what they're willing to pay to address that pain point. And every customer may give you a different answer, and you just have to be cognizant of that.
I want to add a little bit about that. Is one of the things that we see the most common is the founders being in love with their technology and their idea. Mm-hmm. So, and it's not, nothing hurts more than somebody saying your baby's ugly. So I get it. But it is, you do want to listen to that because it's not your baby. It's actually a product that you're making, and really listening to that feedback of how you can make the product meet a business need that the customers have. Again, you have to select the customers, you have to select the market. But once you are after your known problem, you have to iterate on your product, not be stubborn about it.
Yeah, good point.
Next question.
Hi, my name is Justin. I'm the manager of a startup community. Allison has actually spoken to this startup community before. It's about 1,000 founders. I connect founders with investors all the time. And one of the things that I've noticed is that for early stage founders, there's such a difficulty in terms of figuring out like the tipping point for winning to start talking to investors. So from your guys' perspective, when should we start soliciting feedback in terms of how ugly our baby is?
Go ahead.
As early as you're ready to talk about it. So there's a key difference, I think, in it can be really hard when you're a founder, particularly if you don't have a lot of experience talking to investors or being in their community. They're scary, right? Investors are pretty scary, and you don't want to talk to them till like you're all buttoned up and you're ready. But it's all about relationships. It is not about pitching most of the time. The best way forward is at the earliest possible stage, find people who are knowledgeable about what your idea is, where you're building, and ask them if they'll just tell you what they think about it, right? I have a tech platform that educates founders and connects them with angel investors and other early stage non-VC sources. I talked to hundreds of them before I even decided to incorporate my company. They told me how ugly my baby was. My real babies are really not very ugly. They're very cute. Also, they're almost like mini adults right now. So, the more you talk about it, the more it becomes real to you, the more you refine your idea, the more you get people rooting for you and on your page, and they watch you over time. So you should talk to them as early as possible, but it's not for money. It's to ask for their advice and feedback on what you're doing. And then the money conversations become very easy because they've already bought in watching you build from the earliest stages.
Philip has told me how ugly my baby is.
Can I just I want to make one other point to echo what she said. When it comes to relationships, I think one of the biggest lessons, I think, for any founder, when you are starting your company, right, the biggest asset the company has is you, right? So the way you present to investors, and I agree, whether in terms of just having conversations or keeping them informed, I'm not asking for money, I just want to let you know what I'm doing and keep you updated on my progress, is because they are evaluating all of the other facets about you as a person, your grit, your follow through, all the intangibles that come along with not just your idea, but your ability as an operator to try to take your baby and actually make it grow. And so the earlier you can start that relationship, the longer the track record that they have of what type of person you are, right? Therefore, again, it helps with de-risking or reducing that perception of risk. Because at the end of the day, investors, when they're writing a check, they're literally giving away their capital and they're trusting you to be good stewards of it. Right. And so that also not only has to do with regard to executing how you spend that money, but most importantly is how you don't spend that money. And a lot of that happens with the relationship dynamics that get fostered over time.
Hi. I want to give you guys a compliment first. I've been in late stage private equity for 25 years, and I started a company a couple of years ago, which is unbelievably hard. I've seen a lot of horrible panels. This is the best, if not one of the best panels in terms of like the right advice, in my view, for somebody going on this journey.
We'll pay you later, okay?
You don't need to pay me. So here's my
Checks in the mail, right?
No. Here's my question though. Yeah. So what's really hard, and we struggle. So we have a productivity application that we're going to try to get thousands of people that we're never going to be able to meet to pay us whatever, 10 or 20 bucks a month, pick a number, to help us save time. One of the biggest debates we have, Philip, I think you mentioned go to market, right? So product-led growth is great. You can read about it everywhere. It's also really, really expensive. And it's how a lot of these companies go out of business. They spend tons of money trying to build funnel before their product is valuable enough. But it has to be valuable enough. It can't be perfect. So do you have any advice? We've been going down the build value. We have specific engagement metrics, and we're not charging at all for it. And we're inching our way there, but every quarter we're like, should we just pay some money, pay $10,000 a month to Albaloo or whoever, and throw it out there and see if we can drive, these, signups. You may have more churn, but I'd be interested in any advice you have on like how to think about the balance there. It's one that I struggle with a lot.
So I was in Istanbul right before this panel last week. It's one of the best sales experience I've seen. Walk around the bazaar and they'll tell you, come, try the tea, try the delight, try this. And all of a sudden I found myself spending way more money than I wanted to spend, buying things that I never needed and I couldn't fit in my suitcase. I don't know. Exactly. So can't emphasize enough in my experience that early piloting, that early customer engagement. I know it's probably you're watching that cash flow and you're really waiting for that paying customer, but you need that you need those strategic partnerships in order to get to the product, in order to get to revenue. So I would say start with that.
Yeah, we have like 30 companies that use the product for free. The debate is like whether we will be able to get to product market fit doing that, or whether we may be there already and we wouldn't know unless we.
Do you have the right product? Do they want it?
Getting closer. I can't answer that. We're iterating away. I hope to be able to say that we do pretty soon, but I don't know.
So they like the product when it's free. You just don't know whether they like the product if there's a certain.
No, we're not getting enough. We're pretty early, so the product doesn't have. We have very specific engagement metrics. I want the users to use the product and rely on it when they get up in the morning and figure out what they need to do like every day.
Okay.
And that would be the.
Gotcha. Okay, maybe I'll talk to you maybe afterwards.
So it is interesting though, and also my husband's late stage PE, and we have these talks all the time. PE and VC or early stage companies are entirely separate worlds. It really is. But it used to be until the pandemic really that growth was the master, right? People invested in growth. All those metrics you said, doesn't matter if people are paying, just grow. That's the value of the company. That's how you're gonna win. Today, what's sexy is, do your unit economics work, and are people paying you, and do you have a profit margin, and when can you get that profit margin? I don't care about all that growth. Show me that you're making money. Because we saw slews of companies go under because they raised and raised and raised on all that growth, and then nobody wanted them in the end, so there was no exit, right? And they just went under and everybody lost their money. So it is a different time today than it was even just a couple years ago in terms of what to focus on for those engagement metrics. But you know, my gut, again, I don't know you, I don't know your business, but my gut always goes to the customer. Rather than throwing money at marketing, you have people using it. Deep dive, go to them, go to where they're working, look over their shoulder, get in their heads, ask them, would you pay for this? If this went away tomorrow, how devastating would it be for you? Would it be worth $100? Would it be worth $10,000? Whatever your price point is, get to it, do the research, and then charge them. Even if it's half what you ultimately want, there's a difference between free and anything. And I would go there before you start spending on sales and marketing. Understand what they want.
Okay. Hi. My question is about when someone is trying to go 0 to 1, they have tons of things. They have not raised any revenues. They're trying to build MVP and accounting, finance, so many things. What are the common distractions people have so that they always like get trapped into those distractions and trying to do things, and they're like not really achieving 0 to 1? Like, what you have seen as a, like, what are things they should delegate properly, or, you know, should not focus too much? Yeah. Thank you.
Yeah.
I can answer. I don't want to monopolize.
No, please go ahead. We started earlier. Okay.
So, I mean, yeah, one of the hardest things to overcome when you're 0 or 1 or 2 are the distractions. It's maintaining your focus, particularly when it's just you or you and a couple other people. Focus. I suffer from this all the time. I'm constantly doing 200 things to the, you know, detriment of all of them. So for 0 stage, I think one of the distractions you can get into is researching in a silo or building yourself, right? And just constantly building and building, because you can distract yourself with social media, you can get into startup land culture, you can go to every single event, and you aren't out there talking to your potential customers or showing them your wireframes or your MVP and getting that feedback. There's a lot of founders that suffer from distraction until it just isn't viable anymore, because you put it out there and you never got the voice of who you're serving. So focus, if you're going to focus anywhere, get out of startup land and focus on who are you building this for, and go be with them and build it with them. And maintaining that direct contact with your customer will help you focus on what's important.
Thank you. I'll have one more question.
I did not mean to close it out, but I guess I will.
It better be a
thank
good
you.
one then.
I hope so. Thank you for all of the insights. This has been great. So my question relates to, we chatted a little bit about advisory boards in the beginning, and I wanted to know, I would call myself stage 0. So with that in mind, any less obvious pros and cons of forming an advisory board or looking for that sort of counsel versus looking to hire that one employee or find that one co-founder partner. And if you're thinking of going the advisory board route, what would make an attractive board for a potential investor, even at stage 0 or stage 1?
Thank you.
Yeah.
Wants it?
Okay. Go ahead.
I can answer.
Okay. I would say, I think an advisory board can always be very helpful. You know, I would say if I'm at stage 0 and I'm looking to prioritize, right? And my primary focus right now is, I think, how quickly can I get, if I have a thesis of the case in terms of what I think is a pain point in the marketplace, right? How quickly can I get from here to there to test whether I'm right or wrong, right? There's nothing wrong, and it's actually applauded, especially in this country, failing fast. Right? There's an invaluable amount of experience you will learn that can never be taken away from you. Even if you thought this was going to be a product, Market said, not happening, right? So I would try to focus on that first and foremost, right? And if you need to find a co-founder, right? Again, we talked a little bit before about complementary skills that will accelerate you from going from here to here. And whether that's the promised land or that's a cliff, find out as quickly as possible, right? But if you get